Hello and welcome back. One of the subscribers of our channel asked to take a look at Himalaya Capital Management and their holdings. They are a hedge fund. And so he was curious on how to actually potentially invest in this hedge fund, if it's even possible to actually invest with them. And the thing is, this is a private hedge fund, so it's not really possible to invest with them. However, what we can do in a situation where we really want to follow what a hedge fund is doing, we can actually kind of analyze it a little bit and recreate it ourselves, because a fund is just a collection of stocks, pretty much. If this is a stock allocated fund, which this one is, it's 100% about stocks. What it is, it's basically a percentage of a stock and then some percentage of another stock. It's pretty much just a basket of stocks, and as long as they file and we know what kind of stocks and in what percentage they're holding them, we can basically just recreate it ourselves. And if we so want to, we can even follow their updates and sell and buy as they are doing. So, for instance, Himalaya Capital Management actually sold out of Pinduoduo in their latest file here, the latest filing. So, we will try to basically understand what this fund is actually buying here. And I have a very nice table here which showcases what the fund is currently holding and how their holdings are doing. They basically have 6 stocks and the portfolio value is 2.6 billion here. It's 6 stocks again. It's Micron, Bank of America, Meta, Platforms, Facebook, Berkshire Hathaway, Alphabet, and Apple. These are all stocks for which I have made individual videos in my channel, all of these. So you can pretty much, I'm not actually sure about Bank of America. I may not have made one for Bank of America, but for the other ones I have for sure. And you can search my channel and discover these videos if you want to see a detailed analysis of those in each one of these stocks. But you will see here that for this hedge fund here, in their latest report, Q4 2021, they reported 40% of their portfolio being Micron Technology. This is a semiconductors company. And the reported price in which they bought the stock was $93, and right now it's down. They are down almost 19% here. Pretty much all of their holdings are down, as you can see. Some more, some less. Obviously, Meta Platforms is the one that is down the most, and Berkshire Hathaway is the one that is actually up the most. And so the percentage of their portfolio for Micron is 40%, Bank of America 24%, Meta Platforms 11%, Berkshire Hathaway 10%, Alphabet 9%, and Apple's 5%. So one of the things that I was considering potentially adding to my tool here is the option to recreate a hedge fund of that sort, just by basically adding a percentage of specific stocks and how much you want to allocate to those. So for instance, let's say that I have a budget of $10,000. How much would I have to buy out of each of these stocks today in order to recreate it with these exact percentages here. This is probably a tool that I may work on later for the tool, especially if people ask for it. But I think it's gonna be useful. I kind of like the idea. But anyway, let's examine the stocks one by one. I have already taken a look at those and I have them here. Most of these I like, actually, but we're going to take a look at the stock evaluation tool, what it has to say about these companies. Again, I have separate videos about detailed analysis. In this one, I will just tell you a little bit about what the stock is potentially worth right now if you want to add it to your portfolio. And you will see that the max price to pay after all these projections here are set. Again, this have to do with the averages that the company has been doing. So the revenue growth has been 22 for the last 5 years. Last year was 29. You can find the breakdown here. They had a couple of years that were not great here for Micron. And so I went 12, 14, and 16. And the net income margins are, again, you can see them here. They are, way more consistent. And so I went 15, 18, 21, and the free cash flow margin 40, 50, 60. 13% is what I typically use for the annual return that I want to be making. And you will see that the current price is a little bit more than what I would potentially like to get it at. And for our high estimates, we are still within our limits, marginally, let's say. But I think what makes the most sense is to get the stock at around $50. So they bought the stock at 93, which I think is pretty expensive actually, even with our highest estimates. So they did pay a premium here. Now, Bank of America is this is micro. Bank of America is a company that is a bank, and so we cannot really use a discounted cash flow model, as I have explained in previous videos. They are dealing with debt; their operations are around debt, and so their cash flow will be very, very skewed because of that. But what we want to take a look at is the price to book ratio, and you will see here that it used to be more, and now it's back down to 1.25 at the current price, which is $40. Now, they bought it when the stock price was 44, so it was a little bit higher, but I'm assuming that when they bought it, they got a price to book ratio of about probably 1.35, maybe something of that sort. But I think that's a very fair price to book value, really, price to book ratio. Anything near 1 is probably a go, and if it's below 1, it's my favorite, really. Below 1 is where I definitely buy, especially if we're talking about a good company. But yeah, this one is probably an interesting purchase near 1.25 right now, I'd say. So the next one over here is Berkshire Hathaway. That's one of my favorites. Again, I have made a video about it. They do own about 10% of that. Oh, I forgot, Matt, I will do it later. So yeah, Berkshire Hathaway, they own 10% over here. And you will see that Berkshire Hathaway setting even low revenue growth for 7, 9, and 11 because they did have some negative ones. It's a fairly big company. And free cash flow margins and net income margins that are pretty much close to the averages. These are all green here. So even for our low estimates, we are getting that the current price is actually undervalued. So this is one of the companies that I really, really like, and I'm potentially thinking of adding to my portfolio actually right now. The next one is going to be Alphabet, Google, and Google here is 9%. And actually, let me find Facebook first because I jumped over over this one. So I loaded Facebook before we proceed, and Facebook was 11%, a little bit more than Berkshire. If we take a look at Facebook here, again using the pretty much averages, and Facebook has been doing tremendous revenue growth over here. Yet I used very low values, 15, 17, and 19 compared to what they're doing. And the net income margin again fairly conservative, and we're still getting just the low value is a little bit overvalued. The medium one is well within our limits, and the high one is even more way within our limits. But the low estimates are also very, very conservative here. So this is one of the companies that I also love, and I have a lot of it in my portfolio actually. So the next one that they have is Google, and Google here is a company for which I've made a video very, very. It was like 1 week ago? Yeah, about a week ago or so. So what happened here with Google is that I used again very conservative estimates, revenue growth 10, 12, and 14. You will see that 12 has been their worst really in 2020, in the last 5 years. And net income margin and free cash flow margin again are relatively conservative. And we're getting just the low estimates a little bit overpriced. Again, very, very conservative ones, but medium and high well within our limits here. So Google is another company that I really like right now. So I totally agree with this one as well in their portfolio. Apple is probably, yeah, the second one. Actually, MU is not my best right now. I think it's a little bit overpriced, but Apple is probably the same thing. And I also made a video about it, like 10 days ago or so. But it's a great company, fantastic company. The problem is that some of their numbers can be low, like they can have low revenue growth. It's a huge company, of course. They cannot increase their revenues by 30% every year. That was an insane year. So 7, 9, and 11, I think, makes a lot of sense, and it may actually be even quite a lot here for Apple. And if we use these projections, we are again, and these are not very conservative. Again, this can be a little bit aggressive actually even. And in this case, we are 80, 101, and 125, with the current price being 174. So we are above what we'd like it to be. So I think it's actually expensive right now, Apple. Now, of course, it's a fantastic company, but in here we want to examine whether it's a potentially interesting buy that can make us money, because it is undervalued. So we want to be having a margin of safety. So this is how you can examine, using our exclusive tool. You can examine the holdings of a portfolio and decide whether you want to buy. But if you really want to mimic it, what you would do is basically, let's just say that you want to invest $10,000. You will get the 40% of this $10,000 and buy Micron, which is like 4,000. So you will buy Micron technology with $4,000, Bank of America with $24,000, $2,400, and Facebook with $1,100, and so on, $1,000 for Berkshire, and so on. So this is how you would build a portfolio based on this exact holdings here, and you would actually mimic this hedge fund. But you cannot really directly buy it, frankly. And even if you could, I would recommend against it, because if you would buy this one, you would more than likely be paying some sort of fee, some sort of management fee. And it's rather useless, because it's just 6 companies, and you would be paying money out of your own money, out of your invested money, for no real reason. I mean, why would you do that? You can very easily just buy and sell. This is like 6 companies here. Now, if we're talking about an S&P 500 ETF, then that it does make sense to hold it from an index fund, not a managed fund. I wouldn't recommend an actively managed one, mutual fund, generally speaking. But for an index fund like an S&P 500, it does make sense, because it's a lot of companies, and you cannot really allocate all these companies. That would be a massive pain. So in that case, it does make sense to pay it just a little bit, and it tends to be very cheap as well. So this is what I wanted to talk about. I thought this was a very interesting question from our subscriber. Very cool one, and I had the opportunity to examine this hedge fund and kind of tell you how you can reconstruct it, and pretty much make this your own fund. Use this information here to make your own fund out of this portfolio, if you really want to. Hopefully you enjoyed it. Please leave a like if you did, and if you like this kind of content where I'm analyzing hedge fund, like private hedge fund holdings, let me know, and I can make more videos about it for sure. And thank you for watching this one. And again, if you haven't subscribed already, please do so, because at some point you will be getting access to this too. And please leave a like as well. That really helps the channel grow. And thank you for watching this one, guys. Bye bye.